Bull market. A bull market is like a financial party where optimism reigns supreme. It's a period when stock prices are rising consistently, often over months or even years. Imagine a charging bull, head lowered, horns ready. That's the market's upward momentum. During a bull market, investor confidence is high. People believe in the economy's strength and the potential for future growth. This optimism becomes a self-fulfilling prophecy. As more investors buy stocks, prices climb higher, attracting even more buyers. Bull markets often coincide with periods of economic expansion. Companies report increasing profits, unemployment rates drop, and consumer spending rises. It's a time when many investors feel like they have the Midas touch. Everything they invest in seems to turn to gold. However, it's crucial to remember that bull markets don't last forever. They can be punctuated by short-term dips or corrections. Savvy investors use these periods to build diversified portfolios, knowing that the tide will eventually turn. Bull markets provide opportunities for both long-term growth and short-term gains. They're a time to ride the wave of optimism, but always with an eye on the horizon, aware that market cycles are as natural as the changing seasons. Bear market. A bear market is like a financial winter, where pessimism and caution dominate the landscape. It's characterized by a prolonged drop in stock prices, typically 20% or more from recent highs. Imagine a bear swiping downward with its paw. That's the market's downward trajectory. During a bear market, investor confidence plummets, and a sense of uncertainty pervades. The economic outlook often appears gloomy, with concerns about recession, job losses, and declining corporate profits. It's a time when many investors feel like they're trying to catch a falling knife. Bear markets can be triggered by various factors, including economic downturns, geopolitical crises, pandemics, or the bursting of financial bubbles. They often feed on themselves. As prices fall, more investors sell, leading to further declines. This negative feedback loop can be challenging to break. However, bear markets also present opportunities for savvy investors. They offer chances to buy quality stocks at discounted prices, essentially putting premium assets on sale. Value investors often thrive in these conditions, focusing on long-term potential rather than short-term market sentiment. It's important to remember that bear markets, like all market cycles, are temporary. They test an investor's resolve and strategy, separating those with long-term vision from those driven by short-term fears. Successful investors often use bear markets to reassess their portfolios and prepare for the eventual recovery.
Click subscribe to this channel to get more topics you love.
Blue chip stocks. Blue chip stocks are like the aristocracy of the stock market, established, respected, and reliable. These are shares of large, well-established companies with a history of solid financial performance and steady dividend payments. The term blue chip comes from poker, where blue chips traditionally hold the highest value. Investing in blue chips is often seen as a conservative strategy. These companies typically have strong balance sheets, dominant market positions, and resilient business models. They're the corporate giants that have weathered multiple economic storms and emerged stronger. Blue chip stocks are often favored by risk-averse investors looking for stability and income. They tend to be less volatile than the broader market, providing a cushion during downturns. Many blue chips are household names, companies that produce goods or services we use daily. However, blue chip status doesn't guarantee future performance. Even giants can stumble, as seen in cases like Kodak or General Electric. Wise investors balance the perceived safety of blue chips with the need for diversification and growth potential. In many ways, blue chip stocks are the backbone of the stock market. They often make up significant portions of major stock indexes and are staples in many retirement portfolios. Their performance can be seen as a barometer for the overall health of the economy and the stock market. Dividend. A dividend is like a financial reward that companies give to their shareholders, a tangible slice of the corporate profit pie. It's a way for businesses to share their success with the investors who've backed them. Think of it as a thank you note with a check attached. Dividends are typically paid out quarterly, though some companies opt for annual or monthly distributions. They're usually given as cash payments, but can sometimes be offered as additional shares of stock. The amount is decided by the company's board of directors, based on factors like earnings, cash flow, and future growth prospects. For many investors, dividends are a key source of passive income. They're particularly attractive to those seeking regular cash flow, such as retirees or income-focused investors. Dividend-paying stocks often provide a cushion against market volatility, as the income stream can offset potential price declines. However, dividends aren't guaranteed. Companies can cut or suspend them during tough times. A history of consistent dividends is often seen as a sign of financial health and management confidence in the company's future. Some investors specifically seek out dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. It's important to note that dividends can be a double-edged sword. While they provide income, they also mean the company is retaining less cash for reinvestment and growth. This is why fast-growing companies often don't pay dividends, preferring to reinvest profits to fuel expansion. Initial public offering, IPO. An initial public offering, or IPO, is like a company's debutante ball, its grand entrance into the public stock market. It's the process by which a private company becomes public, offering its shares for sale to the general investing public for the first time. Think of it as a business opening its doors to millions of potential new owners. The IPO process is complex and involves multiple steps. The company must file extensive paperwork with regulatory bodies, work with investment banks to determine the offering price, and embark on a roadshow to drum up investor interest. It's a bit like planning a wedding, lots of preparation for one big day. For the company, an IPO can provide a significant influx of capital to fund growth, pay off debt, or reward early investors. It also brings increased public visibility and can enhance credibility with customers and partners. However, it also means increased scrutiny and the pressure of quarterly earnings reports. For investors, IPOs offer the chance to get in on the ground floor of a potentially successful public company. However, they can be risky investments. The lack of trading history makes it difficult to value the stock, and many IPOs experience significant price volatility in their early days of trading. IPOs often generate a lot of media buzz and investor excitement. However, it's important to approach them with a critical eye, looking beyond the hype to examine the company's fundamentals, growth prospects, and competitive position in its industry. Market capitalization. Market capitalization, often shortened to market cap, is like a company's financial weight class in the stock market. It's calculated by multiplying the total number of outstanding shares by the current stock price. Think of it as a quick snapshot of a company's total value in the eyes of investors. Market cap is used to categorize companies into different sizes: large cap, mid cap, and small cap. These categories help investors understand the risk and growth potential associated with a stock. Large cap companies are often seen as more stable but with slower growth, while small caps might offer more growth potential but with higher risk. This metric is crucial for index construction and portfolio management. Many stock market indices are weighted by market cap, meaning larger companies have a bigger influence on the index's performance. It's like a classroom where the bigger kids have a louder voice in group decisions. However, market cap isn't always an accurate reflection of a company's true value. It doesn't account for debt, cash reserves, or other financial nuances. A company might have a high market cap due to investor optimism rather than solid financials, creating a potential bubble. Understanding market cap helps investors balance their portfolios and assess relative valuations. It's a tool for comparing companies across different industries and can signal whether a stock might be overvalued or undervalued. Like many financial metrics, it's most useful when considered alongside other factors. Price-to-earnings, P/E, ratio. The price-to-earnings ratio, or P/E ratio, is like a financial speedometer for stocks. It measures the relationship between a company's stock price and its earnings per share. Think of it as a quick way to gauge whether a stock might be expensive or cheap relative to its earnings power. To calculate the P/E ratio, you divide the current stock price by the company's earnings per share. For example, if a stock trades at $50 and has earnings of $5 per share, its P/E ratio is 10. This means investors are willing to pay $10 for every dollar of current earnings. A high P/E ratio might suggest that investors expect higher earnings growth in the future. It's like paying a premium for a promising startup. Conversely, a low P/E ratio might indicate that a company is undervalued or facing challenges. It's similar to finding a bargain at a discount store. However, P/E ratios should be used cautiously. They can vary widely between industries and can be distorted by accounting practices or one-time events. A company might have a low P/E because it's in trouble, or a high P/E because it's investing heavily for future growth. Investors often use P/E ratios to compare companies within the same industry or to the broader market. It's a tool for relative valuation, helping to identify potentially overvalued or undervalued stocks. But like any single metric, it's most useful when considered as part of a broader analysis. Volume. Volume in the stock market is like the pulse of trading activity. It represents the total number of shares traded during a specific period, typically a day. Think of it as a measure of the market's enthusiasm or apathy towards a particular stock or the market as a whole. High volume often indicates strong interest from investors, whether they're buying or selling. It can signal that something significant is happening with a company or in the broader market. Like a busy shopping mall during the holidays, high volume suggests a lot of financial transactions are taking place. Conversely, low volume might indicate lack of interest or uncertainty. It's like a quiet store on a weekday afternoon. Low volume can make it harder to buy or sell stocks without affecting the price, a concept known as liquidity. Volume is a crucial tool for technical analysts, who use it to confirm price trends. A price move accompanied by high volume is often seen as more significant and sustainable than one with low volume. It's like the difference between a whisper and a shout, the latter carries more weight. Investors also use volume to gauge the strength of a price move. Increasing volume on up days might suggest growing bullish sentiment, while high volume on down days could indicate intensifying selling pressure. Volume provides context, helping investors interpret price movements more accurately. Volatility. Volatility is the financial world's roller coaster. It measures the degree of variation in a stock's price over time. High volatility means dramatic price swings in either direction, while low volatility indicates more stable, predictable price movements. Think of volatility as the market's mood swings. A highly volatile stock might soar one day and plummet the next, like a temperamental friend. Low volatility stocks are more like your steady, reliable acquaintances, less exciting, but also less likely to surprise you unpleasantly. Investors and traders have a love-hate relationship with volatility. High volatility can offer opportunities for significant gains in a short time, but it also comes with increased risk of losses. It's like gambling. The potential for big wins comes with the possibility of substantial losses. Volatility is often measured by the VIX index, nicknamed the fear gauge of the market. High VIX readings suggest investors are nervous and expecting significant market moves. It's like a weather forecast for the financial markets, predicting stormy conditions. Understanding and managing volatility is crucial for successful investing. It influences everything from option pricing to risk management strategies. Some investors seek to minimize volatility in their portfolios, while others, particularly short-term traders, may thrive on it.